Hey, what's going on, YouTube? And welcome back to Tech Conversations. As always, I'm your host, Guillermo. And as always, I'm not a financial expert nor licensed professional. If you plan on investing in the stock market, please consult with one first and invest at your own risk. So, I hope you're having a great day today. It is August 1st. I can't believe it's already August. Honestly, the summer has gone by so quickly. So, let me know in the comment section below if you guys are students. I still get this feeling like I'm going back to school here at the end of August, even though I've been out of college for 2 years now. So again, hopefully you guys have had a great summer so far. Now, today I want to talk about how to exit an options trade early. Okay, I've talked about this before, but I want to talk about it more clearly today. Okay, in fact, I got this question 6 times yesterday in the video that I created yesterday. Okay, so it's something I should talk about, and I also want to give the reasons why you might want to exit an options trade before expiration date. Okay, I have not talked about that before, and so I'm going to be going through two different scenarios when it'd be beneficial to do that. Okay, and if you're new to this channel, I am a software engineer at Microsoft. And before we begin, remember to smash that like button and subscribe because it really does help out this channel. It really helps these videos, reach out other people here on YouTube so that they can learn things like this, things that are beneficial to them, and things that they should know before they start investing in the stock market. And hopefully, they don't end up losing money investing. Okay, so thank you guys so much for your support. I really appreciate everything you guys have done. It's been a great journey so far. And by the way, I do have a Discord. I'll put a link to that in the description below. I have a free version and a premium version. In the premium version, we post weekly watch lists. We have alerts. We have bots that give you instant information on your favorite stocks, instant news, all that fun stuff. Go ahead and check it out if you'd like. So let's get right into this video. Okay, so firstly, if you're new to trading options, I'll put a link in the description below where I talk about trading options in detail. Go ahead and check that out. But as you can see, for my options right now, I have two. I have a put. I have a put that I sold on SPY. Okay, and the strike price is $321. Expiration date is on Monday. Okay, the end of the market day on Monday. So let's go through a couple of examples or two different reasons why you might want to exit an options trade before expiration date, and then I'll actually show you how to do it. Okay, so firstly, let's start with this one actually. Okay, so this is the options profits calculator. Very useful tool when it comes to graphing your options trade so that you guys understand what your max risks are, what your max reward is, depending on the strike price, or depending on the share price of the stock, and depending on what date it is. Okay, and so here I have a simple put credit spread on AMD. Okay, so as you can see, nothing too fancy. Put credit spread. Our net debit or net credit, it's going to be 48 cents per share. There's 100 shares in each contract. So we're going to receive $48. And you can actually see that down here, right? Your entry cost is 48. Your max return is $48. Okay. Now, why would we want to potentially exit this trade before the expiration date, right? Because as you can see, the expiration date is going to be on August 7th, right? And by the way, remember you can choose whatever expiration date you want for this calculator. I'll put a link to this in the description below. Very useful tool. But let's take a look here. Okay, as you can see, look at August 7th. Look at August 6th, right? If AMD were to be August 6th, okay, and August 6th is before the expiration date, right? That's not the expiration date. If on August 6th, the price of AMD is $81.33, right? We have made $48. And remember, that is our max return. Okay, that's the most we're gonna make, right? And so if on August 6th, AMD is $81.33, we've made the most that we can make. It would not make any sense to stay in that trade anymore, right? Because that's the most you're gonna make. It's like if you work 40 hours a week, and if you work 8 hours a day, and let's say any longer than 8 hours a day that you work, you don't get paid more, right? You don't get paid overtime. Then what are you going to do, right? Once your 8 hours are done, you're going to leave, right? Why would you stay and work more if you're not going to get paid more? Same with here, right? Once you've made $48, why would you stay in this any longer? That's the most you're going to make, right? Because you could potentially risk on the next day AMD dropping back to, let's say, $74, and then you'd lose $51, right? So once you hit your max return, which can be before expiration date, you probably want to get out of this trade, right? Collect the money, it's secured, you've made the most you can make, and go invest it somewhere else. Why wait till expiration date and potentially risk losing it? Okay. So here's one example where you would want to exit an options trade before the expiration date. Now let's look at a more extreme example where you'd want to exit an options trade, and we'll actually use SPY, right? Because I'm selling puts on SPY right now. So let's go back a couple months ago, right? Or actually, let's go to the year chart. So we saw what happened, when this pandemic began. So let's go to pre-pandemic levels, right? Let's go to let's go to February 19th. Okay, SPY was trading at $338 a share. Now imagine you wanted to sell a put on SPY on February 19th, 2020, right? You sold a put, and let's say your strike price was, $338, right? Now let's say you chose an expiration date of March 23rd, right? Okay, that's fine. And let's say, right, you just want to wait till expiration date, you don't know how to get out before the expiration date, whatever. Well, what would have happened here? Right, you sold a put at $338 strike price, and expiration date you said you had put as March 23rd. Well, so what would have happened on March 23rd when that contract expired? Well, you would have been forced to purchase 100 shares of SPY at your $338 strike price, even though it's currently worth $222, right? Which basically means you just lost $16,000. You're down $16,000 from selling that put, right? Now, if you know how to exit an options trade, right, and you were listening to the news and stuff, when you heard about the pandemic starting up here in the US, what could you have done? You could have exited right away, right? You could have exited the next day, right? You would have had to pay, a couple $100, maybe even $1,000. But hey, I'd rather lose $1,000 than, $16,000, right? Because if you lost $1,000, you'd still have what, $32,000, and then you could have reinvested it at the dip, right? And then now that it's almost pretty much recovered, you would have made a lot of money. Versus if you had just let this go down until expiration date, right? You would have been exercised upon, and now you're down $16,000. So those are two scenarios right there where you would want to exit before the expiration date. Okay, and hopefully that makes sense. Now let's talk about how you exit an options trade before expiration date. Okay, and again, this is very important to know. You need to know how to do this before you even start trading options, because things like this can happen at any time. It's important that you get out before it's too late. So let's go to my my options trade that I have on SPY. Okay, so again, I sold a put on SPY, $321 strike price, as you can see, expiration date of August 3rd. Okay, so firstly, let's talk about a couple of concepts and what these numbers here mean. Okay, so first of all, contracts. This is going to tell you how many contracts you have. So obviously, I have one. Okay, my break-even price. So this is what this is going to tell me. This is going to tell me that, hey, if SPY is 319.71, you have not lost any money, you have not made any money. Okay, on expiration date, right? So if August 3rd comes and the day ends and SPY ends up being 319.71, I'd be forced to purchase, the 100 shares. But I would not have made any money. I would not have lost any money, right? Because I received a premium of $129. If it's under that, then you're losing money. If it's over that, then you're making money. But this is my break-even price. That's what that means. Now let's go over here, right? This is the interesting stuff. This is what you need to pay attention to. So remember, your credit is how much you received, right? I received $129 for selling this put. And then the other thing that's very important is your total return, right? Which according to this is $104. What does that mean? That's how much profit I would have made if I exited this options trade right now. Okay, that's very important. This number is also the number that you're going to see reflected in your balance. Okay, remember a lot of people sell puts, sell calls, they receive a premium, and then they're like, well, why don't I see it here? Because this actually is going to reflect your total return, right? It's going to reflect my plus $104 and it's going to reflect my negative $22 here. It's not going to reflect the $129 I got. But you do receive that premium instant, okay? So keep that in mind. A lot of people ask me that question as well. So now if I wanted to exit this options trade right now, right, like I mentioned, my total return would be $104. That's my net profit that I made, okay? Now look at this. Market value for this right now is $25. So what does that mean? This means that this contract right now on the market is only $25, right? If you wanted to sell this exact same put right now, you'd only get $25. When I sold this put, I got $129. And so this is important because what this is going to say is if I want to exit out of this trade, I'm going to have to do the opposite transaction, right? And by opposite transaction, I mean instead of buying the contract, I'm going to sell the contract. And instead of selling the contract, I'm going to buy the contract, right? And so since I sold this put, I'm going to have to buy. And it's going to have to be the same type, right? So if it's a put, it's going to be a put. If it's a call, it's going to be a call. So I sold this put, so I'm going to have to buy the exact same put. Okay, and this is very important, so listen up. It has to be exact same strike price and exact same expiration date. Okay, if you choose a different strike price, if you choose a different expiration date, you're just going to add another options trade to your account. Something you probably don't want. Okay, so keep that in mind. It has to be exact same expiration date, exact same strike price. Okay, and so again, I sold this put, so I'm going to have to buy it. Now, if you're on a computer, it actually makes it very easy for you, as you can see on the right here, right? You have buy to close or you have sell to open. So if you sold a put or you sold a call, you're going to buy to close it. If I were to have bought a put or bought a call, then I would sell to open, okay, the opposite transaction. And so I have one contract here, so you would have to do one contract here. The limit price, it pretty much tells you, right? Because this is going to be the exact same as what the market value is right now for this put, right? And so then I would review order and I would submit. And take a look at what it says here. You're paying $25 to buy back. So you're buying your contract back. And look at this. It will release your collateral. Because remember, when you sell put, you have to put aside some collateral depending on what the strike price was times 100. Right? So for this one, as you can see, my released collateral would be $32,100. So it's going to release my collateral and it's going to remove my obligation to buy 100 shares of SPY for $321 each on or before August 3rd, right? And so then I would submit this, and so I would have paid $25. And again, when I sold this, I received $129. Since I'm paying right now $25, my net profit, my total return would be $129 minus $25, which is $104, which again is what you see in your total return. Okay, again, this is a very important concept. It can really hurt you if you don't know how to exit an options trade before expiration date, because again, as you guys saw with my examples, there's definitely instances where you just want to do it because you don't want to wait. You don't have to wait until expiration date, or in more extreme scenarios, where we're going into a recession and things are just falling very quickly. You definitely wouldn't want to wait till expiration date here and purchase SPY shares at a very lower price than what you're paying for them. So hopefully that all makes sense to you. But if you guys have any questions, feel free to leave them in the comment section below. Also, if you plan on using Robinhood in the future, feel free to use my referral link in the description below. If you sign up using my referral link, both you and I will receive one free stock, which is free money for both of us. So let's help each other out, guys. And as always, I hope you guys enjoyed the video. Let me know what you guys think, and I'll see you guys next time.